Welcome back to The Future is On, the new podcast series presented by Global Custodian in partnership with Chainlink. In today's episode, we've got a fantastic conversation between Sergey Nazarov, co-founder of Chainlink, and Nigel Dobson, banking services lead at ANZ. This is another collaboration which dates back some years, resulting in a recent groundbreaking cross-border transaction which involved tokenized assets and stablecoin alongside Fidelity International and the Hong Kong Monetary Authority. This isn't just another blockchain experiment, it's a real-world demonstration of how programmable money, on-chain identity, and interoperability are converging to reshape global capital markets. The pair also discuss ANZ's multi-year tokenization strategy and the tech compliance and regulatory hurdles they've overcome. They'll touch on the critical role of compliance and cross-chain identity in scaling digital assets, and also why delivery versus payment on-chain could be the next big leap in financial infrastructure. They'll finish off highlighting some of the big trends that will shape the next wave of digital asset adoption across global capital markets. So enjoy the conversation, and if you like this one, don't forget to go back and listen to some of the other episodes in this series.
Hi, Nigel. Thank you for joining me for an interesting conversation here on another great collaboration that we've had here with you and ANZ. I think we've been working together for many years now, and it's been a real pleasure working with you and your team and seeing how you are able to progress things not only in Australia, but globally. So I'm very excited to dive in and discuss, this great work that we've done with Fidelity International and the HKMA, because I think it's really cutting edge work for the stablecoin industry in general, and actually for cross-border stablecoin usage in particular, which is where I think you and me feel a lot of the really big global mainstream adoption is in that cross-border unlocking of capital markets. So the first thing that I think would be useful is just to jump into what we did in the new tokenized money use case we did with Fidelity International and HKMA and their EHKD project, which was released in an interim report, very recently. Why do you feel that this use case is so significant for you and for the industry?
Yeah, well, thanks, Sergey. It's really nice to talk to you today. This use case particularly signals a real step change in the level of sophistication of use cases we worked on compared to transactions we've previously completed. And we were delighted to have been selected by the HKMA to test our strongly held conviction that there were wide-ranging benefits associated with tokenized transactions. But why was this significant for the industry? Well, firstly, as you say, it was a multi-asset transaction with a cross-border component. It showcased interoperability between both private and public chains. And secondly, it also, the use case aims to engage a much fuller end-to-end transaction lifecycle. So including the Hong Kong-based tokenized money market fund issuer, Fidelity, all the way through to settlement on behalf of the Australian-based digital asset investor. And within this transaction lifecycle, the group will demonstrate a range of highly desirable features of tokenized asset exchange, including on-chain counterparty identity and cross-chain interoperability, which is where we work with you in Chainlink, as well as programmability, speedy atomic settlement, and with that, a material reduction in counterparty risk, which is really important for us. And we hope this is just another step towards the broader adoption of digital assets and regulated financial markets.
Yeah, it's very exciting. It's actually happening in two phases. I think in the first phase is where you have the payments flow. And as I understand it, the payments flow is showing that you basically have an Australian dollar converted into your stable coin. That stable coin is then converted into the EHKD. Then the EHKD is wrapped and sent over CCIP from your essentially private chain over to the public chain. And that's the first phase, which has now been done, and which shows how you can successfully do cross-border stablecoin transactions, starting in one currency and then ending in another currency. And then I think the value of ending in the other currency is that's where you really get the ability to buy cross-border digital assets issued in a different currency, right? And that in this case was the Fidelity International tokenized fund. And that was denominated in EHKD. And then what we did there was we allowed the transfer agency to work with the digital transfer agency and the NAV data. And then there was this whole dimension of compliance and identity and allowing all of that to synchronize between you and Fidelity International within the HKMA kind of requirements and framework, which I'm sure we'll get to later in this conversation. But the sheer amount of things going on in this transaction, I think is really what you said, that it shows the end-to-end life cycle in a way that we really haven't seen before on these digital asset transactions, where usually you see like a portion of the transaction and another portion, and everyone kind of declares a big success. This is really, I would say, the most complete cross-border stablecoin-driven tokenized fund transaction that I've seen. And it's also exciting because it's not done outside of the regulatory framework of where the digital asset has come into existence, but it's actually done inside of that framework. And I think you have had like a multi-year journey here on tokenization. And I'm just kind of wondering, what are the key strategies or achievements that have shaped your approach and the strategy that you have?
Yeah, well, thanks, Sergey. I certainly agree with your summary of the transaction there, and that end-to-end participation has been really, really key for us. But to your question, we started 3 years ago. Our digital asset strategy was based on a set of long-term assumptions regarding the shape of financial market infrastructure over the next 5 to 10 years. And we had an essential conviction that capital markets and payments would transition from a Web 2 setting to a range of Web 3 protocols over that period. And again, we were seeing that happen before us. And while we expected regulation would move slowly, more slowly than technology, we also felt that much of the existing financial market regulation would be fit for purpose in a professional tokenized asset world. And I think that the transaction we just discussed and that you so well explained, it demonstrates that there's not a lot of variation in the regulatory perimeter. It's more the technology execution factors that have been taken into account and better understood and are proven out. And within that regulatory compliance framework, as you rightly say. But in our early days, we decided we would be blockchain agnostic and maintain strategic optionality where possible. We're very focused on public chain early on because we thought that's where the scaling, the standards, and a lot of the development work was going on. And we issued our first stablecoin, $1DC, back in late 22 on a public chain deliberately to demonstrate our conviction around the value of the utilization of public chains now and in the future. And we subsequently executed a series of live transactions with some of our institutional clients, facilitating purchase of cryptocurrency, tokenized carbon credits. And from there, we began to collaborate more with other banks, central banks, and market infrastructures to explore a series of multinational cross-chain use cases. And that's, of course, where we started working a lot more frequently with Chainlink. And it's been a great partnership, and we've really learned a lot, culminating in the transaction that we've just described.
Yeah, it's been great working with you folks. I think you are really on the cutting edge of not only stable coins, but actually also the ability to use the stable coins in these advanced cross-border transactions. Because it's one thing to generate a stable coin, but it's another thing to get it used for all these asset transactions such that the stable coin can do something useful for your client, right? So it is a great first step to make the stable coin. But then as I think we found in working together, the cross-chain connectivity component and the assets that the stable coin can access actually to a certain degree start to determine its usefulness for your clients. And so I think you folks have really made a great stable coin, but now you're on, I would say, to this next stage of making sure that it's able to purchase a wide array of high quality assets, which maybe your user wouldn't have had access to in their domestic relationship in your own ecosystem, but now through a stable coin, you can have access to, right? And that is an exciting innovation, and I think underscores the global nature of blockchain-based and Web3 powered capital markets, which I know that you're excited about as well. Nigel, to do all of this, you actually have to overcome a lot of challenges, I think. There's a lot of different things that have to go right. And so I want to understand how you've encountered those challenges, how you've overcome them, things like cross-chain connectivity, compliance, privacy, and what has it been like working with us in overcoming those challenges?
Yeah, sure, Sergey. Well, I mean, at a high level, we anticipated a lot of the challenges with a new technology like digital assets and tokenization, and we expected regulatory comfort and clarity to emerge quite slowly, certainly compared to the technology. Also, that building meaningful network effects in regulated markets would take time and often meet resistance from incumbent intermediaries. And so, regardless of these factors, we've seen some industry leaders embrace the concept of asset tokenization and make notable progress, albeit in relatively narrow product areas. For example, we took a lot of heart when we saw the introduction of tokenized ETFs in the United States, which have been brought to market by some of the world's leading asset managers. And that demonstrates that despite many of these higher level challenges, there is sufficient conviction in the benefits of asset tokenization to forge ahead with market-ready innovation. It's also fair to say that these industry success stories have encouraged us to maintain our focus on regulated markets with a very firm eye on test and learn. And with working with Chainlink, we've been able to collaborate on several significant industry experiments, including the HKMA's EHKD case, which we just talked about, and some others that have been allowed us to demonstrate compliance with the cross-chain identity, and also how we could ensure control over tokens issued on different networks. And this has been really important for us. Again, we expect to remain in that regulatory perimeter. We want to uplift the performance and operational resilience of financial markets in general. And that's obviously our comfort zone and where we know our trade well. Also last year, you'll recall, we worked with the MAS Project Guardian. We were able to test and analyze how Chainlink's CCIP private transactions orchestrated transaction settlement across two private permission blockchain environments. And these were both examples of how ANZ is gaining confidence that regulated markets are ready for prime time. And as we look closer to home in Australia, we found significant interest in uplifting transaction efficiency and settlement times from the asset manager community, or as we call them here, superannuation funds. And this seems to be a real sweet spot right now. Asset managers looking for operational alpha, better processes, and even some novel use cases that we've found for our tokens. So, for example, in Australia, funds are under pressure to improve their overall customer experience, the elapsed time of their employee contribution through to investment. And we've found a way to use a digital token or a version of our stablecoin that allows us to move through that financial supply chain between employers making contributions on behalf of employees through to fund administrators who can then reconcile fund member data in real time using tokens that transport both data and value on a single token. And that greatly improves the reconciliation experience and markedly reduces the elapsed time for investment. So even when we're not talking about stable coins, we still find that just the tokenization value of moving data and value together can have a profound impact on a financial supply chain.
I completely agree. I think that's one of the things that your team has done a great job at implementing well, is the ability to have data and value move together. And so not only do you receive the value, but you also receive the details of how that value can and can't be used. And this, in my opinion, eliminates a whole set of systems and processes that really are no longer necessary, right? Because basically, what I think folks don't understand unless they're in the nitty-gritty details of these transactions and how they operate is that you actually have a lot of parallel systems all working at once in the traditional finance world. You have, a value transfer system, you have 3 or 4 data transfer systems, you have an identity system, you have a whole bunch of different systems, and then every bank or every asset manager or every fund admin is basically sitting there and trying to reconcile. So, I have the money, but do I have the instructions? And did I check that against this other identity? And did all of this stuff happen? And to your point, I completely agree that overhead is massive. And I think that the asset management industry is indeed starting to realize that if you can take a piece of value like a stable coin or a tokenized fund, and you can append various pieces of data to it, then you can get massive efficiency gains and speed gains and even security gains because you're not dispersing the data all over the place. And one of the most exciting things that we did a little while ago now was the first transaction we did. I was actually using programmable token transfers. That was for the Reef credit. And so we were able to actually trigger the use instructions, the instructions of what the stablecoin should do when it reached the destination chain, right? So it's actually, in my opinion, going to go even beyond just adding data. It's going to move on to having the tokens be almost autonomous within a certain spectrum of behaviors, right? That you can tell the token what to do when it reaches the destination chain. And it can do that because it has the instructions, it has the value, and now it has all the data to verify that it can perform those instructions. And so this is, I think, the exciting next generation stuff that you folks are working on with us, and that makes it so exciting to collaborate with you and Anurag and all the great folks on your team. You did mention compliance, and I just wanted to understand, what do you feel is the importance of compliance and cross-chain identity for mainstream adoption of digital assets, in what we just discussed?
It almost goes without saying that it's an essential element. I mean, all of our transactions in the regulated sphere today are premised by KYC, advanced due diligence on our clients, on their entities, all of that. So it's table stakes for capital markets transactions. So for us to work with you on testing and analysing and proving out the capabilities of cross-chain identity is just another essential building block of getting to a level of confidence where there will be suggestions of mass adoption in certain areas of the financial markets. So all of those building blocks, all the things that we draw on from Chainlink in relation to not just crossing chains, but with it moving with a very firm footing in compliance and transparency. As I say, it's really just table stakes if we want to scale this kind of technology.
Yeah, I think so. I think the interesting thing for me is that identity is really just another layer of data. Mm-hmm. So there's the value, then there's various data about the condition of the value or the valuation of the asset or some conditions around the value, whether that's a stable coin or whether that's a tokenized fund. And then identity is this kind of so far unsolved problem in our industry where it can stop the show, basically. And the transaction will have to go and revert back to the traditional systems and the traditional layers. And what's really exciting about what I think we're going to be seeing in phase 2 is the ability for the cross-chain identity to really be used in a way that simplifies that flow in a very direct way.
Well, that's right. And Sergey, you mentioned earlier, right, the number of parallel systems that contribute to a transaction fulfillment. And this is a great example where if we can converge the operations of a transaction into a more streamlined flow, including things like identity, KYC, and of course, a whole range of other essential features, then that by in itself almost guarantees an uplift in operational performance. And that's exactly what the industry is looking for. And that's where the economics are going to drive the adoption for.
Yeah, I completely agree with you. I think simplifying these transactions, making identity and AML KYC simple is actually going to be a feature of digital assets rather than a hindrance. Right now, it's still a little bit of a hindrance because it's not a fully solved problem, because CCID is just coming into existence. CCIP is just taking hold. The data oracles are now getting spun up in more and more chains and transactions. But once you get it all working, like in the transaction that we have here with you and the HKMA and Fidelity International, you really start to see this efficiency you're talking about. And then I think that becomes a huge feature of why you want to transact, hold, use collateral in digital asset form rather than in traditional form. And I think you and me are very much on the same page on that being a very strong feature and selling point of digital assets generally, including payment solutions like your great stablecoin. So we see, and you see, I'm sure, a lot of delivery versus payment taking place in the digital asset space. And what is your view on how delivery versus payment is evolving? What effect does it have on tokenized assets, digital cash, stablecoin, tokenized deposits, and their adoption?
Yeah, well, I mean, very simply, if I may refer to delivery versus payment as DVP from now on, it's quicker. Capital markets have only recently started to move to a T+1 footing, while most domestic payment systems in advanced economies are already in real time, already. All right, so the problem statement for delivery versus payment looks far more interesting than does the PVP problem right now. So we think solving DVP problems on chain with digital assets is a bigger long-term opportunity than exclusively focusing on PVP, where a lot of banks are spending time. And that's led us to conclude that the comparative operational and risk mitigation uplifts involved in solving DVP problems easily surpass those associated with tokenized payments alone. Notwithstanding, tokenized payments are an essential feature of any DVP settlement solution. So they will just go together. And the PVP element of a DVP end-to-end transaction will just be folded in as another feature of an overall transaction fulfillment. But that's where, as I said earlier, the economics of operational alpha or uplift will be seen most profoundly in DVP. It's really hard for any commercial bank to compete with real-time payment systems, both either domestically or otherwise, with a stablecoin. The use case is not there. But where we see, our asset manager community, our issuer community, and even our intermediary community seeing the benefits of a DVP type transaction run right through end to end with tokenized assets, with support increasingly from many of our central banks, including the Reserve Bank of Australia, by the way, that gives us tremendous endorsement that we are on the right path, focusing on DVP, where that PVP will be an essential feature.
Yeah, I think the opportunity in DVP is definitely being driven by the tokenized fund trend. And I think what you're starting to see is a greater and greater on-chain inventory of different tokenized funds that will relatively soon start getting used as collateral. And that usage of them as collateral will give them a kind of utility that they don't have in the traditional finance state, because you can't post them as collateral in the traditional finance world on the same timelines or in the same kind of speed that you can in a kind of TradFi blockchain world now. This is, I think, what's going to accelerate the tokenized fund trend even more. And then the systems and the banks and institutions like yours that are well set up for their clients to properly do DVP across all these high quality tokenized funds that the clients then want to acquire, partly for the value of the fund and its efficiency, partly for, I think, collateral, is going to make that DVP approach very successful. And so the DVP approach, especially around what we've done here in this example around a tokenized fund, I think will be that first killer use case of stable coins in the institutional world, where you're exchanging the stable coin very efficiently, very quickly, at very low operational cost and very low operational risk, in exchange for an asset that the client wants, and that is somehow significantly differentiated from the traditional alternative of that same asset. And I think as long as the tokenized fund trend grows and continues, the DVP trend will kind of grow in lockstep with it. Yep. And so that's what I'm looking to see. Does that sound right?
Absolutely right. And I mean, as you say, Sergey, the existence, increasing, proliferation of tokenized assets, but specifically in the fund space, will just simply demand an equal and opposite stable coin with which it can interact, be it to draw down, funding as collateral, or whether it to be just simply for settlement. So, again, the two will go hand in hand. The biggest operational uplift will reside in the DVP experience, and that payment stablecoin, tokenized deposit, whatever it may be, will simply be the settlement token that drives that operational efficiency and kind of ties up the fulfillment of the transaction. We see them moving very, very closely together. They're linked as money and assets are today, but just the brutal efficiency of interaction between those two in the future is going to be very self-evident, I think.
Yeah, I think it's going to be one of those things that was like a weird idea, and then once it starts going anywhere, it's like an obvious idea that's very very successful. So Nigel, as we've discussed, DVP depends on being connected to other chains and their liquidity and their assets. You folks have been navigating this landscape of many public and private chains for many years now. Why do you feel it's critical to have a good interoperability solution for blockchains that integrate across chains with your existing infrastructure? And what's been your experience in using CCIP to solve that problem?
Yeah, it's a great question. Look, we think the likelihood of regulated institutions governing issuance, compliance, and control on private chains is going to remain a high priority for the medium term, Sergey. But we do acknowledge the scaling and cost dynamic benefits of public chains and their ability to draw essential liquidity pools, which will be necessary for mass adoption by market participants. So I think this interoperability question will, I think it will become synonymous with the term integration in financial market technology parlance over the next coming years. But the ability for a CCIP type solution to draw liquidity and really make benefit from the way in which public chains can both track liquidity and pool liquidity, I think will be something you will be spending a lot of time on and be very prominent in.
Yeah, I think the cross-chain connectivity problem, you're right, will be synonymous with integration, because it'll be maybe even the most critical integration for the purposes of the transaction actually working, like the delivery versus payment. And I think folks will view it in two lights. I think they'll view it as a provider of a payment solution or a stable coin, as getting access to more and more digital assets on other chains. And I think then they'll view this problem of integration as a digital asset or tokenized fund provider as gaining liquidity. So basically what you're doing is you're creating this network effect with a cross-chain system. And the more institutions like yours and Fidelity International and HKMA's ecosystem and others that join a single standard for these transactions, the more access to liquidity and the more access to assets they have. And so it has this real network effect that I think we're starting to see now with CCIP, and that I think is going to benefit the early adopters of CCIP like yourselves, because you'll be connected to more high quality assets, more high quality payments, and more high quality counterparties. And so I really appreciate your collaboration on that and all the great feedback you folks have had. I think the stuff we've done on private transactions has also been very interesting, where it's shown how you can actually make two private chains interact with each other over CCIP in a way that maintains their privacy guarantees, their compliance guarantees. And so CCIP has really been built to solve these interoperability, integration, and compliance problems. And I think, as we've discussed, if you don't solve the compliance problem, you don't get the efficiency, you don't get the value of the transactional model of Web3. And so I think it's been great collaborating with you folks and really understanding deeply what it takes to make a cross-chain transaction work well.
Yeah, and I'm glad you brought up private transactions, because that's one of the great steps forward in building confidence with our customers, right? Particularly in a cross-border scenario, regardless of whether it's private to private or private to public. Our customers need to know that their information is private, but they can still access the assets they want to and settle them quickly and efficiently. So that was a real breakthrough for us when we did that with the MAS Guardian project, ensuring that we could prove to the counterparties involved in the transaction that data was kept private, but we could still cross-chain and still interact and transact effectively.
Yeah, that was really exciting that we could make CCIP do that. So that was great. I think we're almost there, and all the time and energy we've been investing in building this technology with you and with others is going to get somewhere now. So I'm very excited about that and looking forward to it. Nigel, it's always a real pleasure to chat with you and to work with your team. Thank you so much for the thoughtful conversation here and all the thoughtful collaboration on this exciting work we've done together. I'm hoping for many more transactions, many more great things to do together, and that we can work together to really set you and ANZ up for success in this new DVP Web3 world. So I'm very excited by that. So great to see you. Thank you for joining me.
Thanks, Sergey. It's been a real pleasure to talk to you. Many thanks.